Hey there, this is Landon Bellum. Thanks for tuning in again to another episode of Realty TV. I'm with Remax Professionals, and today I have a fellow teammate of mine with the Griffith Home Team, the Griffith Home Team Mortgage President, Zach Deeter, and we're going to be talking about financing and specifically about first-time homebuyer programs and everything that you need to know as a first-time buyer when it comes down to locking in your real estate investment. So, Zach, why don't you just give us a little bit of a background on you and how you got into the industry, and then we'll start off with that.
Absolutely. You know, I don't think anyone goes to college saying I want to be a mortgage broker. At least I've never met anyone. So I've been in the mortgage business going back about 5 years now. But I would say I've been in the finance and financial services industry going back almost 2 decades now, back to kind of when I studied it in college, worked in financial services for a good majority of my growing up professionally, and then transitioned here to the mortgage world about 5 years ago, right in the midst of COVID.
Yeah,
so
crazy time to get into the industry, but it was booming a lot. Like, what do they call it? Like drinking from a fire hose or whatever.
It was a different kind of booming, right? Like, yes, there was a lot of home sales during that time, but a lot of refis during that time. So
totally,
absolutely drinking out of a fire hose.
Yeah, that's cool. So been about 5 years, and then you are very recently the president of Griffith Home Team Mortgage. And for context, I'm on the Griffith Home Team. It's a team within Remax Professionals. There's about 25, 30 agents.
Yeah.
And then you are with the mortgage side or in-house mortgage broker. So
exactly,
that's recent, as of January
of this year. Yep. So dabbled at a couple different firms, couple different parts of the industry, you could say, the retail lending world, the mortgage brokerage, which is a very different animal, even though kind of at the end of the day, we do the same thing. And then, of course, incredible opportunity to come join the GHT Mortgage and run the shop over here and work alongside you and a bunch of your colleagues as well.
Yeah, sending a lot of loans your way. A lot of we were just talking about how it's already been it's already outpacing last year in terms of the amount of people that you've helped finance homes. And we are just barely in August. So,
it's been great.
That's fantastic. Really, really good. Well, great. Well, today, Zach and I are just going to break down the home buying process in a nutshell. We're going to talk about first-time home buying and what that looks like from the real estate side of things, and specifically from the financing side and what that looks like. But as we always do on these, on this Realty TV podcast, we always at the end have a Houses of Horrors segment. And so I like to tease it before we get into the meat of the content, just so that people, stay tuned till the end. So for my story, for the Houses of Horror segment, I'll be talking about how I was ghosted, or not just me, but my buyer was ghosted by our mortgage broker 2 weeks away from closing. Totally disappeared, wouldn't answer any phone calls, was just gone, ghosted, and we had to figure out how to get that guy to the closing table in 2 weeks.
We should probably tease that I was not the person.
This was not. Okay. Yes, that is an important thing to talk about. That was not that. So, and then you have a story too.
I have one that was just this year. I guess you'll have to stick around to see whether it actually closed or not. But it involved, which is always the most fun when a real estate agent is selling their own property. There's a little bit more of an emotional tie than there is kind of just sticking to the facts. So we'll talk about that at the end.
Good. Yeah. Sounds great. Well, we'll get into that here in a few minutes, but okay, let's just start off with the home buying process in a nutshell. That's what this first segment's about. So the way that I like to tell people when I'm meeting them for the first time and they're saying, Landon, I want to buy a home. I don't know anything. What does it look like? What's the process? And so I say, hey, there's a handful of steps. Step number one is what we're doing right now. You're talking with a real estate agent, and we need to loop in a mortgage broker. And that's kind of the trifecta. That's the power team there. Is the consumer, the buyer who's about to purchase a home, the real estate agent to guide on the real estate side, and then the mortgage broker to guide on the financing side. So step one, finding the right professionals in the industry. Step two, getting pre-qualified for a mortgage. It's super important, and we'll talk about why, but you need to know how much you can afford and what you are qualified to purchase in terms of the price of a home. Step number three is where you start shopping. That's where you start looking at homes. We go in and we see what you like and if there's anything you want to buy. And then step four is where we start to make offers, and eventually one will get accepted and we go under contract. And then that's the transaction phase. Step five, the inspection appraisal, we'll get into that. And then lastly, step six is closing. You go to the closing table and get the keys. So that's the nutshell. That's the home buying process. Let's break that down. So in terms of step one, why do you think it is so important to make sure that right off the bat, you are with seasoned professionals on the financing and the real estate side. What has your experience been with that?
I mean, purchasing a home, especially purchasing a home with a mortgage as well, is probably one of the client's most complicated financial transactions they'll ever make in their entire life, right? So a lot of times people think, oh, real estate agent or mortgage broker, dime a dozen, right? There's a ton out there, right?
Heard that before by close friends and family.
For sure. Yeah. They're not all created equal, right? And an analogy I use with clients and even real estate agents is, and I'm not a huge sports guy, so bear with me on the analogy. Imagine you have a quarterback and a wide receiver, right? Imagine they've never played a game together. They've never even practiced together, right? Now, a good quarterback and a good wide receiver, if quarterback throws a nice pass, odds are that the wide receiver is going to catch it, right? You can kind of put that as like a simple real estate transaction, right? Where everything goes smoothly, no bumps, no hurdles, no landmines, anything like that involved, right? Well, you and I both know those are rare, right? Those transactions, they're nice when they happen, but they're uncommon.
Especially in this market right now. I don't know what it is. Things have gotten really tricky on the purchase and the sell side.
Absolutely. Absolutely. And so, you take on the flip side of what if you have a quarterback and wide receiver that have played together for 10 years, right? Yes, they're, just like the previous combo, they could catch a ball with, little to no pressure, so to speak. And their odds may be 50-50, right? But now you take a team that has worked together a ton, right? The odds of success just go up greatly. Totally. And I think a lot of consumers and buyers, they kind of miss that fact that like, oh, well, I'm just going to work with the loan officer at my bank,
or who go online on, one of these websites that offers the lowest possible rates that can happen. And it's just some random person online. Or
exactly. And they don't realize some of the nuances that do go into mortgages. Like, is your mortgage broker available on the weekends, right? When are your clients typically looking at homes? It's usually not Monday through Friday, 8 to 5.
Weekends and after 5 p.m. on weekdays when banks close and these online people are nowhere to be found.
Exactly. So, I mean, that's just one example of what, sometimes buyers, especially first-time home buyers, don't pick up, with their first purchase or their first home purchase, that I think it's why we have a lot of people come back to us, right, for their second or third or fourth purchase or whatever it might be. But it's really just making sure the team, like you said, kind of the trifecta. I mean, you want to make sure that's a solid trifecta because, I mean, you hinted about your horror story, at the beginning. There is a greater chance that something goes awry when that triangle is not how it should be, right? And so that's important.
And to go into your analogy of football, right? What happens in the game of football when you miss the pass, right? Oh, well, you go to the next down and you get to start over. What happens in real estate if you miss the pass? That could be a $10,000. That could be a $20,000. That could be the difference in monthly payments of $500 a month. Like missing a pass in this industry when you're buying a home, and this is something that for first-time home buyers who are probably watching this don't understand, like this is a big deal. And if you don't have a real estate agent who's representing you properly or a mortgage broker who is truly listening to what you need and what is important to you, you could miss out big time, and it's going to cost you a ton of money. This is the biggest purchase that most people make in their whole lives, and you don't want, Sally, who's part-time and doesn't do this that much, is only, you just don't want to make that mistake. You don't want to open yourself up for that. So, so that's why I see the first part of the home buying process is you gotta get tuned in with someone, with a professional realtor and a professional mortgage broker that click well, know each other, and can get it all going. So, okay, step number 2 then. Getting pre-qualified for a mortgage. That's something that I recommend is the very next step. Okay, you've connected with myself. We've connected with Zach. Next step, you got to get pre-qualified. Most of the time before we even go see homes. And many times I go see homes before someone's truly pre-qualified. But why do you feel that's important to have done so early on in the process?
Yeah, I mean, I think it's going car shopping without having a budget. Right? Yes, that Maserati would be great to purchase. But is it really in your budget? And while you may want that car, do you want that payment? And that's what I talk about a lot with clients about. You may want that house and you may be able to actually qualify for that house or qualify for that car. But at the end of the day, do you really want the payment that goes along with it? Because
really well said. For some people that might not understand, what do you mean by qualify? What does it mean to be pre-qualified or to qualify for the house? Because not everybody who's watching this might know.
Yeah, good question. So, I mean, there's a lot of things that go into that, right? So it's about, and maybe we'll talk about this, but the difference between pre-qualification and pre-approval, right? And I'll kind of use them synonymous just for simplicity's sake for today. But really, when it comes to qualifying, it's a lot of times people say, well, I have a $3,000 monthly rent. Why can't I qualify that for a mortgage, right? And a lot of times the people are paying that for rent. Typically they can qualify, but not always, right? And so there's a lot of things we have to look at. And I call it the three legs of the stool. It's employment and income. That's our first leg. So that's the first thing we look at.
Are you employed and what's your monthly income?
Are you employed? What's your employment history been like? Are you self-employed? Are you paid W-2, right? Lots of things to look at there. And how are you compensated, right? Are you hourly? Are you salary or commission, bonus, right? And everyone's picture, you believe it or not, is pretty complicated when it comes to that, right? The second leg of the stool is credit and debts. Okay, so that's essentially, what do we get from your credit report? Not only does your credit report tell us your credit scores, it also tells us what debts you have on there. So whether it's car loans, student loans, personal loans, what have it, right? That's kind of the next thing we have to look at, right? And I'll get to why those two stools are so important. But the third stool is what we call the assets stool. So do you have money for down payment, for covering closing costs, if we need reserves, right? There's a couple things that fit in there. But let's go back to the first two legs, because this comes back to like, what do you qualify for? When you're going through the pre-qualification or pre-approval process, the holy grail of what the mortgage industry looks at is, what is your debt to income ratio, right? DTI for short. So, I mean, and that is debt divided by their income, right? So what are the debts we're looking at, including
student loan, car loan,
all of that, including the new home purchase, right? And then what's the bottom number, right? What's the denominator? That's your income. So like, what level of income can we use? Maybe you got a great bonus last year, but we don't have a 2-year history of that. Well, that bonus in our world does not exist, right? And so knowing all of those pieces are extremely helpful, and it ultimately gets us to, can you qualify for the home or not? A lot of times people want to know, what purchase price can I qualify for, right? And they hate me for it until I explain it to them, is that I don't actually pre-approve you for a purchase price. I'm actually secretly pre-approving you for a mortgage payment. Now, we like to back into what does that look like for a purchase price, but ultimately what I'm pre-approving you for is an actual monthly mortgage payment. Because again, it comes back to your debt to income ratio.
How much do you make on a monthly? And this is how much you're going to owe on a monthly for your mortgage. And you also have that credit card debt, and you also have the car loan and student loan. That all factors in to your debt to income ratio. And
it's not as easy as saying, well, 50% is our max debt to income ratio, because it depends on the loan type are we using, right? Are we doing VA, FHA, conventional? What's your credit score? There's all of these three stools. They all tie into each other, right?
But ultimately, getting down to the weeds, or getting down to the base here, it is so important to get that pre-qualification done with a mortgage broker like Zach right off the bat, because you need to know, if you want to buy a home for $500,000 and you have, a $10,000 down payment, is a lender comfortable enough, given your financial situation, the things we've talked about, to give you that loan? If so, great, you are pre-qualified. If not, then no one's going to fund you. No one's going to lend you that money that you need to buy this home. So you might have to adjust that price.
Well, and I'll say, I very rarely, if ever, have people come to me that say, wow, I started this process too early, right? A lot of people come to me saying, I wish I had started this process before I did, because there's no harm, there's no cost, other than a little bit of your time and some of my time in just doing the pre-approval, doing the application, collecting the documents.
It doesn't hurt.
It doesn't hurt, but what hurts is when someone comes to me and we find out there's a collection on their credit report, or there's a credit card they didn't know about, or something like that, because those things take time to fix.
You want to know that early on.
Exactly.
And the other side of it is, you're right. You might have a great financial situation and you might qualify for a $700,000 home. But once you break it down and say, cool, just so you know, with your situation, a $700,000 home is a $4,500 monthly payment. That might change things, and you might be like, oh, okay, well, I'm qualified. The lender will give me that much money, but I'm not comfortable paying that. So now we need to adjust the price again. And the example I always give is, I had this, and this is where I learned why this needs to be step number 2 in the home buying nutshell process here, is because I had a buyer that I was working with who was super flexible on where she lived. She could be anywhere in Denver. So we would, there was times we literally went from, Lakewood to Aurora to Thornton, which is just a perfect triangle around the whole Denver metro area. I mean, we spent hours in the car and we were looking at homes in the 500,000s, and she wasn't pre-qualified yet. She hadn't spoken to a lender yet. And we found out that we were looking at homes that were $200,000 more than what she could afford for both what a lender would give her and for what she was comfortable with more monthly payment wise.
Yep.
So we wasted a ton of her time
Yep.
and drove to all these homes that looked amazing, but wouldn't work for her. And so it ended up being fine because once we had a realistic view, we could look at good condos and good townhomes and good things that would work for her.
Yep.
And we utilized our time much more effectively.
Well, in a lot of in today's world, right? A lot of people look online, whether it's Zillow or some other online tool, to figure out a calculate, right? A calculator for what a monthly mortgage might be. You just have to keep in mind those tools are only as good as the inputs that you're putting in. So if you don't know what the HOA is for a property, or the taxes, or what estimated insurance is going to be, or what your private mortgage is, or your interest rate, right?
Yeah.
Any one of those variables being off, it turns into a little bit of a wild goose chase for you and for your client. I hate to see agents waste their time showing homes that clients can't qualify for, but more so I hate when clients waste their time and get their hopes up, because it's a very emotional process. And so it's like, if we can just have the quick 30-minute conversation, stop everyone from wasting their Saturdays and Sundays looking at homes that they can't afford or maybe don't want to afford. That's why I think it's so important for that to be step 2 in the process.
Well, and you said a word that is very true: quick.
Yeah.
Getting pre-qualified is quick. If you just fill out an application, provide some documents, you can get pre-qualified within a few business hours, assuming that you're available.
Absolutely.
Sometimes even after business hours, depending on the situation, if we need to make an offer quickly. So it's not like it's something that takes a lot of time. It doesn't cost you money.
Exactly.
There's a lot of ways we can go around that. So it's something that just needs to be done. Do it early on. It does not hurt you. Okay, step number 3. That's when you start shopping for a home. So you've connected with a real estate agent. You've connected with a mortgage broker. You've got pre-qualified. You know what your budget is. You're ready to go. That's where I really, really come into play. And you're not as involved in this part as much. You are, and I'll get to it. But that's when we start shopping for homes. I set the buyers up on some searches online, and Zillow or Realtor.com. All these other sites are really good too at seeing homes that are available. And that's when we go out and start doing showings. You start looking, seeing what you like, what you don't like. And when we get to that point where you're like, Landon, I really like these 2 that we saw today. These are great. That's where I take those addresses and I send them over to you.
Yep.
Again, we got that trifecta. And I say, hey, why don't you just run us some numbers on what these look like in terms of payments? And you put together, okay, here's an estimate on what the taxes would be and your mortgage payment and the interest rate. And here's just a rough estimate just to give you an idea.
Yep.
And then you're like, that's really realistic. And the buyer can really start to think, okay, am I ready for the next step?
Yep.
And the next step is, okay, let's make an offer. We've got the pre-qualification letter, which I need to be able to submit alongside the offer to show the sellers that my clients can't afford the home. They have to see that. They have to have that certainty that they're qualified. And then we put an offer together.
Yep.
What price do you want to pay? Do we want to get aggressive and try to get you a deal? What should we do for the closing date? That's where we put all of that together. We put it into a nice, crisp offer and submit it to the sellers. And that's where they can do one of 3 things. They can accept it without any objections. They can counter it and say, we're not going to give you that price, but we'll meet you here. Or they could outright reject it, which does happen when you come in really aggressive on price, where they're like, oh, that's not going to work. We're not even going to counter it.
Yeah.
Resubmit if you want, but we're a little bit offended by that price that you gave us. But at that point, you've made an offer, and ultimately you will go under contract. And then that's where both of our jobs really start to speed up and get going. So going under contract, that just means we have submitted an offer to a seller on the buy side, and the seller has accepted it. We have a mutually signed offer. We're moving forward with a closing date in mind. What on your end starts the minute that I send you a contract and say, Zach, we are under contract?
Yeah.
And closing's on this day. What happens?
If I've done my job, or whoever the mortgage professional the client's working with has done their job, it should not feel like a bunch of added stress to the client, right? If I've done my job well from the beginning, I have all the information I need. I have all the documents. I've pulled the client's credit, right? I've set them up. They have an idea of what the payments are going to be. While my processor will then come into the picture, who who helps with the fine details along the process of paperwork and documentation of what the underwriter is asking for. But we do start that underwriting process, right? And so, you know,
And maybe explain, what is the underwriting process?
Yeah.
Who is the underwriter?
Yeah.
What is that? People might not know.
Yeah, not me. Thankfully, not me.
Yeah.
These people are different animals. They think in different ways. And I mean, underwriters are basically taught to figure out how this client would not be able to pay the mortgage in the future, right?
Pick their financial situation apart and make sure that they are bulletproof.
Exactly. And you know, I tell clients a lot this anecdote. I say, listen, you can lie to your spouse, you can lie to your friends, you can lie to your family. Don't lie to your mortgage broker, right? Because we will eventually find it out, whether it's me or the underwriter. We're gonna figure it out some way or another.
Delays,
and,
extra costs.
It's gonna be painful. So, you know, the process starts with, we get initial disclosures sent out. That's essentially the client telling me, yes, everything looks good. My interest rate is locked or floated, whether it makes sense to do one or the other at the time. Start with the initial disclosures. Then we take everything we've gathered from the client, we submit it to the underwriter. Now, the underwriter is the person that is looking at the mortgage application, looking at the credit report, looking at all the documentation, just making sure everything checks out, right?
Can these people truly afford this loan and this home?
Exactly. And then, you know, they typically come back. They want some additional information that is very common, maybe a couple additional documents, updated bank statements, you know, just typically some little stuff. Like I said, if I've done my job up front, it should be a relatively stress-free process. Now, there's always things that come up in any transaction, and that's what we're there for. We're there to help the client through that transaction, and be the liaison between the client and the underwriter, right? I do this every single day. The client maybe does this once every 5 to 10 years, right? And so it's important you have someone that is experienced and knowledgeable about the process, and I can be the liaison between the buyer and the underwriter. And then, you know, we continue to go through that process. We get to the final stage, which is what we call the clear to close, or that's the fancy word for essentially the final underwriter approval. And from there, we're off to the races and closing on the home.
There you go. So from the minute that we go under contract, that's what it looks like on the financing side. You provide additional documentation. Your file goes to underwriting. Once you get through that, financing side is done and we're good to go. The minute that we go under contract, on my side, which is important for, you know, first-time home buyers to know, we got a lot of work to do too. The first thing that we really start gearing up for is the inspection. We want to make sure that home that you are about to purchase is something that you are comfortable purchasing. And at this point, I've either seen the home once, twice, or maybe 3 times with that person. So a total of less than probably 2 hours worth of time in that house. We want to make sure that there's nothing that we missed. And so I have an inspector. I'm going to have him come on one of these next episodes, but he goes through, he's done over 1,200 inspections in Colorado in the last few years. And so he has seen so many homes. He knows what to look for. He knows what to find. He's looking for water issues. He's looking for structure issues. How's the roof? How's the furnace, the AC? Is there any leaks? What am I missing? What could he potentially find that we didn't see that we need to know about? So the inspection, that's one of the first things that happens. And then at the same time, we're kind of working on getting property insurance quotes going so that you have the home insured. The lender requires that. And then one of the next things that gets done on the purchase, if you're taking out a loan and financing it, is an appraisal. So why don't you explain, because that's very heavily on your end. I work a little bit with them if there's an issue with the appraisal. But what is an appraisal? Why do the buyers need it? What's the issue?
Great question. The appraisal is really to get an objective view at the value of the home. Okay. Now, when it comes to an inspection, like you were talking about property inspection, the inspector is going to come in. They're going to spend 3, 4, 5 hours in the home. You know, they're going to look for anything that's possibly wrong with the house. The appraiser typically comes in. They may spend 15, 20 minutes, you know, measuring the rooms, making sure the square footage is accurate to the public records. But a lot of the appraiser's work is done outside of the home, right? Because what an appraised value is just essentially what would similar homes to this sell for in this geographic area. Okay. Typically it's about a radius of a 1 mile radius, right? But what have homes similar to that home in the last 6 months, what have they sold for, right? An appraiser doesn't just walk into a house and be like, 500,000, right? It doesn't happen like that. They, like I said, they go in, they measure, they make sure everything's accurate with the home, but then they leave and then they go look at comparable properties. How have they sold? What is different between property A and this property? And what's different between property B and this property? Is there a better view? Is there a 2-car garage versus a 3-car garage? And they make adjustments for all that stuff to try to get it as even as possible, right? And then from that, that's where the value is determined. And now those appraised values are extremely important in our process, in the mortgage process, because at the end of the day, the lender is only going to lend you money based on what this appraiser says the value is, right? So
yeah, because up until this point, this is the price that you're paying for the home has come down to a few opinions. Come down to the opinion of the listing agent that listed the property for sale and his seller, the person who's selling the home. They've come to an agreement on, okay, this is what it's worth. This is what we'll list it at. And then the third opinion is between myself, the buyer's agent, and the buyer. And so that's where this price has come from at this point. And by this point, before we even go under contract, I will have run comps of my own to make sure, okay, I don't want you to overpay for this house.
It's not a shot in the dark.
We're not just totally agreeing to what the seller listed their property at. If they've overpriced it, maybe we came in where we thought the price should be or whatever. We've looked at the value. But ultimately, this is the appraiser comes out because the lender wants to make sure that the person who is getting a massive loan out on the property is not drastically overpaying for it, and they're lending all this money for a home that's not even worth that much money, right? Is that kind of a way to explain?
Yeah, I mean, because appraisals are done and required not only to protect the lender, but also to protect the client, right? And I think a lot of clients may fail to realize that like it
I think
feels,
I realize it.
And agents, yes, they may fail to realize it from time to time as well. But really, the appraisals are required to not only protect the lender but protect the client from overpaying on the home.
That's fair. That's a good analysis. I like that a lot.
Yeah.
So you get the appraisal done. There's other documentation. If there's an HOA, you get HOA docs. All this stuff is happening during the transaction phase, which is good because you don't want to just say, "Cool, I like the home. Here you go. Here's all my money. Let's buy it next day." You want to make sure that you have all the information that you need to then go to the closing table, fund the deal, put all this money up, take out a mortgage, pay the money, pay the interest rate and everything that you're going to pay for something that you really care about and want. And the good news is the Colorado real estate contracts, they really, honestly, overly protect the buyer, where if there's an issue with the appraisal or the inspection or the HOA work or documents or the title work or anything, there are contingencies in which you can terminate the contract, back out, and start fresh. Go find a new home. So that's the transaction phase in a nutshell. There's a lot more to it, but that's a pretty good highlight and overview. And then you get to the last step of the home buying process, and that's where you go to the close. You probably do a final walkthrough of the home, make sure it's still good after the seller's moved out. You go to the closing table at the title company. You bring your down payment. Either you've wired it or you bring a check, and then the lender funds the rest, gives you the loan for the rest, and then you get the keys. And there you go. Yeah,
that's the fun time.
That is the fun time. We've been through all the hard parts at that point, and you get the home. And it's over. So that's the nutshell. That's how to buy a home, steps 5 or 6 or however many that was. So now let's get into something that I think concerns a lot of people, and that is, how much does buying a home cost? There's a lot of costs involved, a lot of money to pay in different ways. So how much does it cost to buy a home? So the first thing that I mentioned, going back to the home buying process, the costs really don't start until you go under contract. You have put an offer out, you have signed the offer, the sellers agree, they signed the offer, you are now under contract. Now here comes some of the costs. So the first one that I see is the earnest money deposit. The sellers will want you to put some money on the line, some skin in the game, to show that you're not going to just not show up to closing, that you're not going to back out for no reason of the contract and have them off the market thinking they're going to close with you, and then you just ghost them and ditch them. So the earnest money is usually 1% in Colorado of the purchase price. And that 1%, so let's say you're about to buy a $500,000 home, it's very standard for a seller to say, great, we accept your offer. We now require you to give $5,000 in an earnest money deposit to the title company, just to hold on to, just to show that you are in. And if you're out, you will be out for a legitimate reason, like the inspection or something.
And I have to remind clients all the time that earnest money is not an additional cost it's essentially them prepaying
Yep.
their down payment. So let's say your down payment is $25,000 on a $500,000 home. In your case, 1% earnest money. That $5,000 in earnest money, well, that is already $5,000 of the $25,000 that you're planning to bring, right? So it's not an additional cost on top of everything.
It goes towards the money that you need to bring to the closing table anyways.
Exactly.
So if you were expecting to bring 30, now it's 25.
Now it's 25. Right? Exactly.
Yeah, well said. But that is something that everybody's going to require. Sellers just need, you just have to have some skin in the game. And luckily, if there's a big issue with the transaction, we can get that money back for you in full almost every time. So the next cost that typically comes in that transaction phase is the inspection. So the inspection is typically priced to have a home inspector go out and take a look at the home. It's typically based off of the size of the home. So if you're buying, a moderate 2,500 square foot home, that standard home inspection for the inspector to go out there for, like you said, 3, 4, 5 hours, look at everything, that typically costs, for that size of a home, probably somewhere in the $400, $500 range. In fact, my home inspector, he gives all my clients 15% off. I just send him a lot of business, so he just gives a little kickback to the people I send him. But yeah, I'd expect around $400, $500 for a home inspection for a home that's around 2,500 square feet. Now, if it's a bigger 5,000 square foot home, you're looking more like 600, 700, give or take. I'm just ballparking a little bit here, but there are some inspection add-ons that you really need to consider on top of that standard home inspection price I just quoted. One is a sewer scope. You really want to spend the extra $150, $180 to have a sewer professional come out and send a camera down the sewer line to make sure that there's no cracks or trees or roots in the line, because that's an immediate $10,000, $15,000 fix that if you didn't know about, you're going to have to take the hit on.
And we see those all the time.
All the time. And so if you run into that and you paid $180, that's the best $180 you spent.
Absolutely.
Because now you can say, hey, seller, we're not moving forward and buying this home unless you fix that line. And then they take care of it for you most of the time. And then another add-on, radon. Radon's an odorless gas that's pretty common in Colorado. It's not like carbon monoxide where it can kill you in an instant. It's more like it can lead to lung cancer. It's found in basements. It can lead to cancers and stuff over a long time and lots of exposure. Again, it's a $150 test that you add on to the standard home inspection cost, and it would probably save you $2,000 for a radon system to be installed. So money well spent there. And then there's other tests you can do, mold tests and things, but I don't usually recommend them as much in Colorado just because it's a dry state. If there's mold, the home inspector will probably find it anyways with his thermal imaging of walls and stuff. There's moisture or water buildup. And then if it's an old home, you can consider getting like a lead-based paint or an asbestos test, but nothing that I typically recommend as standard. So all in, depending on the size of the home, $500, $600, $700, $800 for your home inspection to have the peace of mind knowing that things are good, or to make a list of things that aren't good for the seller to take care of for you. So, appraisal. What should people expect for the cost of an appraisal?
Typically appraisals, and it does depend on the home size or the home price more so. They're usually somewhere between $700 and $1,000. Now, if you're buying a property out in, a rural part of the mountains here, they may add a trip fee of $100 or $150 on top of that. But typically you're looking at somewhere between $700 to $1,000, which most clients will not pay up front like they will an inspection. That's something that gets added as part of closing costs. And I think that's something that we're going to talk about later. But closing costs is kind of a boilerplate for a lot of different expenses that are incurred during the process. And so the appraisal fee just gets added to that.
And you can, by the way, for a lot of first-time home buyers out there that are very closing cost conscious, where they don't have a lot of money out of pocket. They want to buy a home. They've got a down payment, but they don't have that much extra. They don't want to tap into too much savings. Most of the time, inspection costs can be added onto closing costs too. So you can pay it at the end instead of upfront. Make sure that everything's gone through and all that. So, anyway, okay, so let's get to closing costs then. So do you have a simple way to kind of break down a couple different layers of closing costs? The way that I kind of wrote it down in this outline is like closing costs. These are like the lender loan fees associated with them. And then closing costs part 2, which is more of like the title, HOA and kind of other miscellaneous fees. But what do you expect? What should people... what do people need to know how much they need to have on hand for these things?
So closing costs are notoriously difficult to estimate, right? They're typically, I tell clients, it's somewhere between 1.5% to 2.5% of the purchase price.
Yeah.
Right. So like if you're buying a $500,000 home, that would estimate they're between what, $7,500 and $12,500.
Which is a pretty broad range.
Very broad.
But it's better to over prepare than under prepare.
Exactly. And I always try to overestimate closing costs with the hope that they're going to be lower than what that number is that I've estimated. Clients tend to not like surprises at the closing table, and I don't blame them. So I try to help out with that as much as I possibly can. The tough part about estimating closing costs is, because there are so many items that make up closing costs. One of the biggest ones that people don't think about is what's called accrued interest. And I'll just give you a quick example. Like, let's say you go under contract on a home today, you're closing September 1st. Okay. Your first mortgage payment is not till November 1st. Okay. But when you get a mortgage, just like when you get any loan, that loan starts that day. The lender who lent you the money is going to start collecting interest that day. It all turns into a function of when they receive that interest from you. So close on a house September 1st, your first payment is not until November. So essentially all of September's interest has to be collected at closing. So it gets added as part of a closing cost. Well, on a $500,000 loan in today's environment, that could be $2,500. Right? Or more.
And that's why it's hard to estimate, because when is your closing date? Is it going to move? Like that's
if it's the last day of the month, now we only have to collect for one day, right? So instead of $2,500 closing at the first day of the month or the last day of the month, it's a massive disparity between that. And so that's where this 1.5% to 2.5% range comes in, is because there's so many factors that we just don't know until you're under contract. The month of the year you close in can actually impact your closing costs. What your homeowner's insurance is going to be can impact your closing costs. So, let me take a step back to your original question about like, how do I break it down? We really break it down into like closing costs, which again, I know is a generic term, and then prepaid. So like closing costs is going to be underwriting fee, processing fee, if any. We don't charge a processing fee, but a lot of lenders do out there. Credit report, title fees, right? A lot of the, that's kind of what I put into like the closing cost bucket. Then we talk about prepaids and escrows, and that's probably a topic for a different podcast, because we could spend an hour talking about that kind of stuff. But you prepay your first year of homeowner's insurance when you purchase a home, right? Which people are not used to, because if you have renter's insurance or car insurance, you either pay it monthly or every 6 months, right? There's so many different ways. Well, homeowner's insurance, 99% of clients are going to pay their first year at the closing table. And so what is that number, right? Does the house have an older roof? Does it have a newer roof?
Is it in a flood zone or fire?
Exactly. So many factors. And so
HOA usually asks for a couple months.
HOA will want a couple months of, of working capital, as they call it. There can be transfer fees for HOAs. Another one is taxes. Right. So two things that we're sure of in life: death and taxes. And so in Colorado, we pay our property taxes actually February and June each year. However, when you purchase a home, you're going to be paying 1/12 of your taxes every single month. Those get essentially deposited into a piggy bank, right? And then your lender pays the taxes when they're due in February and June, right? So you're not getting that massive bill for 6 months of property taxes, unexpectedly in February when you're, purchase your first home. You're slowly saving for it, right? And so that gets added in as part of closing costs, because they'll collect a couple additional months of your property taxes and your insurance. And so there's a lot of things that go into closing costs. They're not easily understood. But if you're working with a good lender and a lender you trust, they should be able to kind of talk you through from the start of the process to the end of the process, how those numbers it's a dynamic process. So those numbers are going to fluctuate a little bit as we go. But you're working with a lender that you trust. They should be able to explain those to you pretty clearly.
And I think you did a great job explaining them too. And don't worry, if you're a first time home buyer watching this, you don't need to know all of those things. It's good to know, okay, what's the general idea of what I'm paying for? But ultimately, if you just expect, okay, I have to pay for an appraisal and an inspection, and together those are maybe $1,500 together. And then closing costs are going to be around 1.5 to 2.5%. Okay, now I've got a good idea of that. And then the last thing that you really need to be aware of is just your down payment. How much are you going to bring to the table of your own money to put towards the house, which will lower your loan amount, and how much money are you planning on a down payment? And we'll talk about that in this next section where we kind of get into first-time home buyer programs or just first-time home buyer benefits that you might have to kind of give you an idea of how much you need to prepare for a down payment. So yeah, I think that gives a pretty good idea on cost. So let's just jump into it. So the next segment, what first-time home buyer programs or benefits are there in Colorado? What should people be on the lookout for? What should they be preparing for? Let's just dive into the first-time home buyer benefit.
Yep. I get this question daily, right? And there's kind of a differentiator between first-time home buyer benefits and down payment assistance programs. And a lot of times clients get those confused, right? So down payment assistance programs, I have some excellent down payment access to some excellent down payment assistance programs, whether it's through some of the local partners like CHFA, the Colorado Housing and Finance Authority. Metro DPA is another very popular down payment assistance program. I have some other private down payment assistance programs through the lenders that I work with that, are not state specific, but can be a good option for a lot of first time home buyers. So that's one component, right? That's where we can get help with the down payment assistance. Now, I always say, and I learned this in Econ 101 in college, there's no such thing as free money, right? There's no such thing as free lunch. There is truly no such thing as free money.
Yeah.
There's not agencies out there that are just like swimming in money looking to help people buy homes, right? And so there's always a give and a take. For example, at CHFA, right? Their most popular down payment assistance program, they give the client 4% towards their down payment, which if for a first-time home buyer can cover 100% of your down payment. However, they do it as a silent second mortgage. And so it's kind of a secondary loan. There's no interest on it. There's no payments that have to be made. But at some point, when you refi that house or you sell that house, you do owe that money back, right? So it's really important that you're working with a lender that's also not only knowledgeable, but transparent about these programs, right? Because you want to know what you're getting into with them. Because like I said, no such thing as free money. Okay.
Yeah. The last thing you want is to think, oh, wow, I just got this free money for a first-time home buyer program and they paid for my down payment. Yay. And then you have to sell the home in a year and you don't realize, oh, crap. Now I have to find that money to be able to even sell this house.
Exactly. So that's down payment assistance. First-time homebuyer programs. One thing I'll say with them is first-time homebuyer programs are not designed for people making $1 million a year. Okay. These programs typically will have income caps on them. This year in the Denver metro area, it's about $160,000 is where they cap. So that's combined income that we have to look at. There's some ways to kind of work around that a little bit. But again, they're not designed for clients making $1 million a year buying their first home, right?
It's really trying to just help those who are a little bit tighter on finance.
Exactly. Make it, hey, we struggle with affordability in Colorado with not only where interest rates are, but just where our home prices have gone.
True.
300 days of sunshine, I don't blame people for wanting to move here, right? And but people buying homes, they feel that pinch a little bit. And so anything we can do to help qualify for these first-time homebuyer programs, some slight advantages when it comes to private mortgage insurance or interest rate. Hey, every little bit helps. If it ends up being $100 or $200 a month, that's real money, especially to first-time homebuyers. There are, a lot of times kind of a misnomer I hear is FHA loans in that they are for first-time home buyers. They can be used by first-time home buyers. They can be used by people buying their fifth home, right? And so they're not necessarily for first-time home buyers. They're a great tool because it's a program more designed for those that may be, working on their credit or may not have depth of credit history. And so they may not have the scores for a conventional mortgage. So that's why a lot of times people think about it.
FHA is just first-time home buyer, not the case.
Exactly. And I think overarching, the most important thing is the client doesn't have to come to me knowing which program they want to use. That's my job, to look at their situation and to determine what is the best program for them.
Yeah, well said. And I think just as a general rule of thumb, and it gets a lot more like this is where you come into play to help them go through, okay, you've got a couple of options here. Here's what I recommend given your situation. But if you're just doing kind of a traditional conventional mortgage, most of the time, kind of the first-time home buyer benefit is that you could put just 3% down on that, right? As opposed to if it were someone who's bought a house before, the minimum's typically 5%.
Correct.
So it just means you can buy this home because you're a first-timer and you don't have to give the lender as much money at the closing table for your down payment to be able to get this home. Whereas for FHA loans, again, some of those loans that can help if you don't have as great of credit or things like that, the minimum is usually around 3.5% for those first timers.
Correct.
Right.
Yep.
Yeah. Okay. Just making sure that
Yep.
I was following along there.
And another loan program, and this doesn't apply to everyone, but for VA loans, for our veterans or active military, they can get into homes with 0% down.
Yeah,
right?
Without any of the Jaffa things where you have to pay
Yeah.
back or anything. It's just you're
Exactly.
a veteran.
0%. You can finance 100% of the home. I mean, it is by far the best loan program out there, as it should be, as a thank you back to those that served our country or currently serving our country. And so,
Nice.
you know, VA is an extremely valuable loan program that our veterans and active
Great
duty
rates.
should
You
use
can put
them.
0% down.
Yep.
And you don't get dinged anywhere like you would for a down payment assistance first time program thing.
And no private mortgage insurance. So,
Yeah, which adds up very quickly.
Exactly.
Great. Okay. Well, we got just a couple segments here left, and then we'll jump into the Houses of Horrors segment. So one thing that I've been helping first-time home buyers with a lot in this market, because if you think about it, 2020, 2021, 2022 even, rates were historically low. I mean, interest rates were 2%, 3%. People's mortgages were so dang low and so dang affordable because of those rates. And that changed very quickly as soon as halfway through 2022 hit, where they started to skyrocket, you know, in comparison.
Yep.
Anything above a 2% or a 3% feels like it's skyrocketed, but historically maybe that's not an appropriate term, but interest rates are high and affordability is low. So we've got rates right now at like in the mid 6s, high 6s, low 7s, just depends on the person and their whole situation, like we talked about at the beginning. But one thing that I've been really helping, especially the first-time home buyers with, is, hey, here are some really cool and creative ways that we can make your house payment more affordable. And there's a couple ways we can do that, and they all revolve around obtaining seller concessions. And we do that in the offer phase. So do you want to explain what a seller concession is, or maybe should I do that more part of my side, or what do you think?
I'm happy to do it. I mean, you're the one that's negotiating
I
them.
procure them, but you're the one who uses
them.
So, yeah.
Exactly. So, I mean, a seller credit or seller concession, same exact thing. It essentially is the seller giving the buyer a portion of their proceeds at the closing table, right? There are limits on how much can be received, and those seller credits cannot go towards their down payment, which is important, I think, from the previous topic we talked about. But those seller credits can be used to cover a portion or all of the client's closing costs, and can also go to help cover some of the strategies that I think we're about to talk about.
So the one thing that I always ask is, hey, what is more important to you? 3 things. Would you rather have less loan to pay back over 30 years? Would you rather have more money in your pocket after you get out of the closing table and get the keys? Or would you rather have more affordable monthly payments? And a lot of the times, one of those 3 is very important to the first-time home buyers I talk with. Some people are like, hey, the less loan, the better. I don't care about anything else. I just want a smaller loan. Great. Then this home's asking $600,000. Let's see if we can get them to accept $575,000.
Yep.
On the other hand, if that home is asking for $600,000, I can say, great, let's give them $600,000 in our offer, but request that the seller pays us $25,000 in seller credit. And to the seller, it's the exact same as if we offered $575,000. But now what we can use that seller credit, that $25,000 for, is we can pay for your closing costs entirely. At that price, entirely for sure. And now all you have to bring to the closing table is your down payment.
Yep.
All of those costs and fees were taken care of by the seller.
Yep.
Awesome. Now, if you're of the third box where you feel that long term, I just want to have more affordable monthly payments. Interest rates are high. I want those to be lowered. So we can take that $25,000, throw it at the lender, and the lender will buy down your interest rate. A few ways we can do it. We can permanently buy down the rate with that seller money that we procured. We can do temporary rate buy downs, which helps out dramatically. There's lots of things we can do. So why don't you break down interest rate buy downs and what that looks like and how big of an impact that can have?
Yeah. Well, first, I think we should set the stage on rates, right? Because you talked about rates being high. I would correct you and say rates are higher, right? To relative memory. And you kind of talked about like 2 and 3%. And a lot of people are sitting at that, but month after month, we see the charts, and the people that have 2 and 3% rates, you know, that percentage is dwindling because life happens. New jobs happen, families grow, families change. And so while people have not wanted to relinquish their 2.5 or 3.5% interest rate, at some point life does happen. You have to make that decision, right? So that's one thing. I mean, rates historically, if you look over the long run, we're actually pretty average or slightly below average.
6-7%.
Yeah. I mean,
Too bad.
I always argue, I think our economy has changed quite a bit, compared to, it's hard to compare today's rates to 1970s rates, right? It was
18% or something.
Exactly. Very, we hear all our parents talk about that. And so the world has changed and our economy has changed. Will we ever see that again? I don't know. Your guess is as good as mine, right? But I don't think so. And so are we on the higher end of the range that we'll be at? I don't know. We might kind of be where we are for the long run, which I know is not what people want to hear, but it's sometimes what you need to hear, right? So to your point, what can we do to combat just higher than recent interest rates, right?
Higher than 2021.
Higher than 2020, yeah. And so two main ways, and you hit on both of them. Permanent rate buydowns, which not the biggest fan of in this environment, but it's my job to present the options to the client, let them make an educated decision on that. And that's where let's say your interest rate paying no points, right? And points are just a way to essentially buy down the interest rate. Let's say that rate is 6.5%. But let's say the client could use $3,000 in points or $3,000 from seller credits to buy that rate down to 6.25%, right? So we've gone down 0.25%. That may change the client's payment by $100 to $200 a month, right? Depending on the loan amount.
Which to some people is massive.
Exactly. Now, the thing that clients have to realize is that, especially when you're buying your first house, it's not going to be your only mortgage you ever do. You're going to refi at some point in time, more than likely. Talked to a client today and he said, oh yeah, I bought my home back in 2007. I've refied 6 times since then, right? And so that's over a 18-year period. And so that's likely
refinancing or refiing, as you call it.
Yeah.
Maybe just a quick explanation on what that is in case someone doesn't know.
It's basically redoing your loan at a new interest rate. So more advantageous interest rate.
Rates come down, you refi, costs a little bit of money, but now all of a sudden your 30-year fixed rate was 6.5, but rates came down to 5.5. You hit the refi button.
Exactly.
And now your rate for 30 years is 5.5.
Exactly. Now you've locked that back in. You've started a new 30-year period. So overall, it should reduce your monthly payment, right? So saves you money. Now, the downside with permanent rate buydowns is once you pay that money up front, while it may save you, let's say $200 a month, let's say you spent $4,000 to buy that rate down to save you $200 a month. If a year goes by and now it makes sense to refi, you've really only saved yourself $2,400 and you paid $4,000 upfront to do that, right? Now, I would argue it's a sunk cost. You need to make a decision at that point, not about what it cost you back then, but what impact it's going to have going forward. But it's why I'm not a huge fan of permanent rate buydowns, just because the payoff period, the break-even period, I should say, is somewhere between 4 to 5 years. It's typically
if rates come down in 4 to 5 years and you did a big permanent rate buydown with your own money or with seller money, like we talked about. You didn't see a return on that. It wasn't worth it.
It's a bet. It's a bet. It's a bet with the lender that I'm going to essentially have this mortgage long enough to have made back what I paid you plus some. Right. So that's why permanent rate buydowns not my favorite right now. I think there's a good chance that clients will have an opportunity to refi in the next 12 to 36 months, right? That is a long range. That's 1 to 3 years, right?
But over a 30-year loan, 1 to 3 years is actually not that much.
It's not. And I tell you this, the smart people over the last couple of years, they have been doing the, marry the house, date the rate. Well, guess what? People are still dating that rate that they told them to date years ago. So you have to be comfortable in the payment today. That's the most important thing. And then we hope for the best down the road. And so like I said, I think it's probable that clients will refi within the next 3 years, I would say. So I don't think you're going to quite hit where it was a smart move to bet that you're going to have that mortgage longer. I could be wrong. I hope I'm right, and I hope there's an opportunity to lower rates for clients. But that's kind of an unknown, right? It's an unknown bet you make. Now, a temporary rate buydown is much more of a known bet, right? And I wouldn't even say it's a bet. Essentially what a temporary rate buydown is, and there's a couple different options, but I'll just hit on the most popular option. It's what we call a 2-1 buydown. Okay. So, let's say a client's interest rate is 6.5%. Okay. Now for the first year with a 2-1 buydown, the client is going to pay a payment based on an interest rate 2% lower than that 6.5%, right? So if you calculate their mortgage payment, it'd be calculated at 4.5% for the first 12 payments, exactly. And then for the subsequent 12 payments, for payments 13 through 24, it's going to be based on 1% lower. So the way to think about it is it's like a little like step up every year in your payment, right? It can help you adjust to being a first-time homeowner. Maybe, you're expecting an increase, a promotion at work, or an increase in your compensation, right? It can be a good way to for a short term in this example, 24 months, to kind of help you subsidize that monthly mortgage payment by using what we call a seller paid 2-1 buy down. So it goes back to getting the seller credits we just talked about a few minutes ago, utilizing those in a way to help with the affordability, especially for first-time home buyers.
Yeah. And just to reiterate why I love doing these so much, I've done these for probably dozens at this point of clients, where all of a sudden your 6.5% interest rate for the whole first year is 4.5. And then for the full second year is 5.5. And that literally comes out to saving you hundreds upon hundreds of dollars a month for the whole first 12 months and for 13 through 24 months. Like, it's hundreds of dollars in difference. It's short term. So if there's no refinance that occurs in between that 2-year frame, your payment does go back up to whatever the payment was at the 6.5%. But what it does is it buys you time, like you said, to get more comfortable, buys you time to have a promotion at work. It buys you time to do a refinance. And all of a sudden you never even had to pay off of the 6.5. They're super, super helpful, and first-time home buyers are taking advantage of that in strides. It's a very helpful tool.
I would say about 50% of clients I've worked with this year have a temporary rate buy down in some way, shape, or form, right?
Yeah.
And I think good numbers to tie to this is, let's say that you get $10,000 in seller credit. So if we use your example about the $600,000 home and knowing you can get it for $575, well, what if you go offer $585, take $10,000 in seller credit, right? Same to the seller as a $575 offer. And instead we go use that $10,000 for a 2-1 buy down. That could save the client without having the exact numbers off my head, $300 to $400 a month for the first 12 payments. Well, what if you just got the home at $575 with no temporary buy down? That would reduce your monthly payment by about $65. Okay. Now that's $65 for 360 months, right? For the length of the loan. But as we just talked about, the odds of refining between now and 5 years, let's say, is pretty good. Basically what it does is it takes those monthly savings with the 2-1 buy down and it just front loads them, right? And let's be honest, that's when first-time home buyers need it the most. They don't need it in month 359. They need it in month 2, right? So that's kind of put some numbers to it, why they're so much more popular right now, especially rather than just paying $10,000 less, which really help our affordability, specifically with first-time home buyers.
Yeah. And the best part about the temporary versus the permanent rate buy down is, hey, if rates do come down and you refinance in 8 months, that money that's still remaining in that account that's buying down your rate every month, that just goes straight to your principal, right?
Exactly.
That just goes straight to your loan and buys your loan down. If there's $10,000 left that you haven't used and you refinance, goes right to the loan.
If you don't use
the permanent buy down, you've already paid it. It's gone.
With the temporary buy down, if you don't use it, you don't lose it, which is extremely important. Whereas a permanent rate buy down, if you quote unquote didn't use it, you don't get it back.
Yeah. And so ultimately, I don't think there's necessarily a wrong answer here to make buying a house more affordable. I mean, right now, it's a buyer's market. Buyers can be aggressive. Go aggressive on the price and have less loan. Great. Get some seller concessions and have your closing costs paid off. Awesome. You have more money in your savings account now. That's great too. Or use that closing cost credit that you get from the sellers to get a rate buy down and make your monthly payments more affordable permanently. Or temporarily. But either way, I don't think there's necessarily a wrong way to do it. This is a market to where you can do it, which is also why, hey, I get it. Rates are high. It's not affordable. Prices in Colorado are high. Rates are high. It's a tough time to buy. If you can do it, and if you can make those payments, there are more deals happening right now, more motivated sellers, more inventory to choose from than there have been in years and years. And so if you take advantage and you lock in a home, I mean, you are going to be able to get more bang for your buck than you will if rates come down to 5.5. Because if rates come down to 5.5, everyone who has been waiting is going to jump back in, and it's going to be a tough time.
That's an excellent point, Landon. And I had a client
no problem. That's a good point right there to cut.
Yeah.
Good job. Good time. So I just ended by just saying, and we'll wrap up here. We'll do the Houses of Horror segment, and then we'll be done.
I'm just going to hit on that about like trying to create a little urgency.
Mm-hmm. Okay.
Yeah. Go ahead.
No worries. Take your
How
time.
long? I have no idea. No concept of time. How long have we been going?
I started the stopwatch a little bit late. We're at 45, so it's probably 50-ish.
Okay.
Yeah.
Okay.
Yeah.
I was just going to like try to create a little urgency there in terms of like not waiting for rates to come down and what that's going to look like and how painful it could be for first-time home buyers.
Yes.
Okay.
I agree. But I think we've done great in terms of the timing. We've hit on everything I wanted to hit on.
Okay.
So, and there was a lot. There's a lot more to talk about with this than there was when, Rochelle and I talked about like Sterling Ranch and Roxborough. That was a geographical one.
We could sit here and talk for hours.
And this is good. Like if there's a first-time home buyer who truly watches this from beginning to end, they're going to be like, I mean, it'll blow their minds.
I mean, we could do another one.
Mm-hmm.
I mean, I'll do as many of these as you want.
Yeah.
I mean, we could do it on like purchasing investment properties.
Exactly.
Like
that would be so good.
Stuff like that.
Yep.
Like different types of loan program, like DSCR loans and all that kind of stuff, right? Like we could get into a lot of like stuff like that.
And I think that would be great because a lot of people are catering to this first-time home buyer market, but other than providing out those. That's a good idea. Maybe what we'll do, because I was going to do one with Dustin that was about the episode I was going to do with him first was how to buy investment properties and to start your investment portfolio. So maybe we could do like a trio on that one, and then we can talk about, okay, cool, what's the financing side look like for all of this?
Yeah.
And then Dustin can speak with his experience on short-term, long-term, what do you need to do? How do you make it happen? It's not easy to get in, but once you're in, how can you snowball it?
Yep. Was the 1031 class good yesterday?
Good.
I should have stayed on.
That dude he's kind of boring to listen to, but
sometimes those are the best people for those kind of things.
So good. Like everything, he was boring just because he was kind of an older guy and he just was boring to listen to, but he wasn't like, he didn't say, everything was really applicable, really useful information. He can go in on the weeds of things where it's like, I'll never need to know that. Everything that he said was like, that's actually really helpful to know. So I should have paid a little bit more attention.
Because 1031 exchanges are one of those things that people I don't feel like know a ton about them, right?
So many misconceptions
until you really need to know them.
Yeah.
And then it's like, oh gosh, where do I go?
Yeah. It's interesting. I always thought that they were just a loan program out there, but it's more like you work with that with like a CPA.
Yeah. I mean, we have nothing to do. Like, we're not trained on 1031 exchanges. We are told not to talk about them, because it has nothing to do with us. The financing is the same.
Yeah.
Right?
It makes sense.
It has more to do with like the ownership transferring component, right?
Yeah.
I don't know.
Yeah. They're interesting. So that was good because, we always have clients that bring them up, and it's rare that people actually use them. You need to be working with like a serial investor to really, really be actively doing those, but still people bring them up all the time, and there's so many misconceptions on them. I've got some folks right now that are moving in from Wyoming and like, oh yeah, we're going to do a 1031 exchange, but it's like, okay, yeah, but this is, so you have a home in California and then you have this home in Wyoming that you're selling and you want to 1031 it, but it's not a rental property and you want to 1031 it into another residence like that.
That's
you
not
can't do that. They're like, no, I think we can. It's like,
no, you can't. Whatever happened to your Montana people that had like the ranch up there?
Yeah, so they're under contract right now. We put in a ridiculous offer on a home. We basically, like, it was set like 14 days on the market and it was asking 1.45 and we put in a 1.25 offer and they ended up being fool. They said, you come up 100, we'll go down 100. And also we'll give you until September 2nd to be under contract.
Oh, dang. So they gave them a long time.
A crazy amount of time. They're still like, that long time is starting to be eaten up because we're not under contract over there. But, I mean, they gave us tons of flexibility on it. So we'll see. But so they're under contract right now. We just got through the inspection and I just got to hope that Montana sells or else back to square one.
Where do you want to pick up?
Yeah. So, yeah. If you want to just go in and just
you just want me to start?
Yeah, just start saying like, just however you want to speak towards we'll just have a cut there. How you want to speak towards kind of the urgency of let's see.
Yeah, about interest rate, not waiting for interest rates.
Yes.
Okay.
Yep.
Landon, that's an excellent point. I actually had a client email me last night, no joke, that said, "Hey, I rent out my condo currently. I'm looking at buying a new home for myself, but I think I want to wait till interest rates come down." And my response to him was pretty straightforward and candid. Is there are thousands and thousands of buyers just in the Denver metro area that are doing the exact same thing, right? Yeah. I tell clients all the time, like, if you have the means, if you have the down payment and funds to cover closing costs, if you have the ability to pay the mortgage, at current rates and current home prices, do it now. Because the people that are going to benefit from interest rates coming down are going to be existing homeowners, not so much the new homeowner, right? And that's because the existing homeowners get to do what we talked about earlier. They get to refi. They get to reset their interest rate to a lower number
in the house that they've already bought.
They've already locked in the price, right, at today's prices. Which, whether you're watching this a week from when it was taped or a year from when it was taped, it's a buyer's market right now in the Denver metro area. But also, like, the new buyers are going to have to be fighting the demand that we're going to have when rates come down because of those thousands and thousands or tens of thousands of buyers that are waiting on the sideline, right? And a lot of first-time home buyers today don't know what it felt like in 2021, right?
If you're watching this and you're a first-time home buyer, you don't know what it was like. Imagine having to compete home after home, offer after offer. Every time there's a dozen offers on the table, you have to go way over the asking prices to be competitive. You have to waive your inspection. You don't even get to have an inspection because no one else is doing it. Like, it's so competitive.
Yep.
And I don't know if we'll see that to that level again, but I can guarantee you there are thousands of people that are also waiting under the premise of, I'll buy when rates come down.
Yep.
So when rates come down, it's going to be a little bit of a crazy market.
And a lot of those people simply can't, this brings us full circle. Some people can't qualify at today's rates and home prices, right? And so they have to wait. But that's why I say, if you have the means, if you don't have to wait, you really should consider trying to find that property now and not waiting for rates to come down, because it's all supply and demand. Rates come down, demand goes up. What happens when demand goes up? Prices go up. And so are you completely offsetting the reduction in rate through an increase in home price, right? And you don't get to reset that home price like you can reset an interest rate through a refi. You're at that price for life, so to speak.
And I think a lot of people right now kind of expect to get the best of both worlds, where it's like, I want prices to come down and I want rates to come down. That's when I'll buy.
Yep.
Well, I'll tell you, once rates come down, prices are going up again.
Yep.
And right now, rates are high. Prices are coming down a little bit. Now, we're not seeing a crash, but I was just telling you before this podcast, like, we just went to a home and they were asking $1.45 million. They were on the market for not even 2 weeks, and the buyer came in $200,000 below on their offer, and we ended up settling in the middle. We got $100,000 knocked off the price immediately, just because it's a tough market to sell. You can get aggressive on price right now. Now, it's not, I don't foresee a crash. I guess crashes can always happen, but I don't see that happening. But if rates come down, prices are going up again. That's just how it works. So it's tricky, but it just comes down to, can you afford it? And is it a little tight? Okay, let's talk about an interest rate buy down. Let's see, like, does that make it comfortable? Does that buy you the time you need to make it even more comfortable? Great. There's lots of ways we can get creative. And if there's anything that you and I are good at, Zach, with that trifecta, is we're good at getting creative to tailor the home buying process to whatever the buyer needs. So
exactly.
Well, I think that was a super informational podcast. Let's go ahead and wrap this up with our Houses of Horror segment, and then we'll call it a day. Again, going back to the little teaser from the beginning of mine, I had to navigate a situation where I'm literally less than 2 weeks away from closing. There's this buyer, he's 2 weeks away from getting the keys to the home. And all of a sudden his mortgage broker just goes MIA. Wouldn't answer any phone calls, wouldn't answer any emails or texts. He was gone. And what happened was, this is, again, it goes back to why you need to have a very seasoned professional, but more importantly, someone that, if you have a good agent, a good real estate agent representative, who is their go-to? Because they've obviously done a lot of deals together. Zach and I do a lot of deals together. I know that Zach is only going to pre-qualify my buyers if they are truly in a good space to be able to do it. What happened was, this mortgage broker just wrote like a really quick pre-qualification letter for my buyer to go under contract and put an offer to buy a home. And this broker did not know the extent of the financial situation of this client of mine. And what ended up happening is, sure, this client made $9,000, $10,000 a month. He had the income, more than the income needed to be able to qualify and purchase the home that we were under contract for. What he also had was over $100,000 worth of student loans and car loans, and all this other debt that had racked up, that and a bad credit score too. all these things, all these variables that come into play. And it got to the point where the broker realized this guy cannot afford to buy this home. No lender is going to get this through underwriting.
Mm-hmm.
This will not happen. And he knew that it was his fault that we had got this far in. We were past the inspection. We were past all this stuff. We'd gotten so far in that we were just, a week and a half away from getting the keys. Well, no keys were ever going to come because no lender was ever going to qualify. Like, it was never going to work.
Right.
So the guy disappeared. And so we tried to salvage it. I ended up giving to the guy who was formerly at Griffith Home Team Trip, and he tried to salvage it. He's like, Landon, this is not possible.
Yeah.
It's just not even possible.
Yeah.
There's way too much debt and way too low of credit. There is no lender in the world who will fund this.
Mm-hmm.
And so we ended up having to send a termination letter to the sellers, and they were pissed because we had gone through
I don't blame them.
They should have been. No, they had every right to be. Not only does it suck to all of a sudden, so close to closing, get a termination letter, but they had already done a ton of inspection work. They had paid out of pocket for, quite frankly, some silly things that my buyer had asked for that weren't really necessary. They paid a couple $1,000s out of pocket to fix a deck that was actually in pretty good shape and to do some other things. So they were like so furious because we terminated because we couldn't fund this loan. It wasn't going to happen. And they'd already put in work that most other buyers wouldn't have asked for.
Yeah.
So, and then I haven't heard from that guy since. So
he
didn't end up buying that home, and he kind of went MIA and ghosted me too. But it was just, it was a mess because, and just to wrap this up, like the agent was just calling, yelling at me. He had his managing broker, his boss, basically calling me and saying, why are you terminating? You can't do this. This is illegal. We had every right to, but it was messy.
Yeah.
It was a nightmare.
Well, and that's a great story for this podcast specifically because I always joke, pre-approval letters aren't worth the piece of paper they're written on. Mm-hmm. Now, it's kind of tongue in cheek because we're not actually writing a pre-approval letter on a piece of paper. It's all electronic now.
True.
But it has nothing to do with what that letter says. It's the person who wrote it, right? And so it goes into like who's the lender that you're working with and how solid is their reputation. Are they local or are they based in another state, right? We have more skin in the game when our reputation's on the line here.
100%.
And so it kind of goes back to what we talked about originally. If the pre-approval process is done well and complete, the rest of the process should be relatively smooth. And I think your client and ultimately you were a victim of that.
It was terrible.
Yeah.
It's so bad for everybody.
So my house of horrors was actually a recent story. It should scare anyone initially when I say a condo. Condos are notoriously a little more challenging sometimes on the financing side. But to add to add something worse is that the seller was the real estate agent that was selling the property, which you and I both know there was always a little bit of an emotional tie that she had to the property. And so, then to make matters worse, the clients, my borrowers, the buyers were lovely, lovely people, great clients to work with. They had been living in China for the last 15 years. They were U.S. citizens working abroad, working at an English school over there, and were ready to kind of, as they called it, adult up and move back to the States. They have 2 young kids. And so this was their first home moving back over here. And so they were lovely to work with. It's a little bit challenging when you're dealing with foreign income. Naturally, I'm getting pay stubs that are in Chinese. That's challenging. But ultimately, what was the nail in the coffin ultimately for the deal? And to answer my teaser from earlier, no, this transaction never did close. And it comes back to an appraisal. Appraisal on like a $340,000 condo came in about $30,000 less, right? Well, on $1 million home, that isn't a massive underappraised, but on
that
a
purchase price
like a 10%, it's big, right?
I don't think I've ever seen that. And I know this is an agent on our team who had these, but I remember hearing this, and my job, when I saw that in our group chat, I was like, it's rare for appraisals to not appraise in this market, but that far off, that's a crazy market.
Well, and the agent already thought we were getting, or the clients were getting a good deal on it because it was already below what it was listed at. So it was just a function of, and it goes back to what we talked about appraisals. The initial list price is the agent and the seller, which in this case was the same person. It's their opinion on what they think their home is worth.
Which could be off by a lot.
You know how it is. Owners typically think their home is worth more than it is, right?
They're real estate professionals or not.
Yep. So sometimes when appraisals come in low, we can negotiate our way out of it and find a common ground and find somewhere that all parties still want to get the deal done at.
Yeah.
Unfortunately, the seller was just not having it, and we ended up terminating. And the clients moved on to buy something else. So
yeah, okay.
Everything happens for a reason.
Did they end up getting something good?
They did.
Okay.
Yep. Very happy.
Good.
Kind of a silver lining to the story.
Dang, craziness.
Yeah.
Yeah, those appraisals can come in and bite you for sure. And that's why you just gotta do your due diligence and be ready for anything during that transaction phase, because that can really flip things upside down. So
absolutely.
Well, great. Well, thanks again, Zach. It was awesome chatting. I think
Thank
this
you.
was incredibly valuable, and anyone who made it this far had lots of golden nuggets to go through for sure. So, but yeah, stay tuned. Got a couple of great episodes coming up here soon. We're gonna have my inspector out. We're gonna talk about some of his horror stories, and I'm sure he's seen sorts of nasty stuff, literally.
I'll be watching.
Yeah, that'll be good, and tons of others. So thanks again for tuning in, and we'll catch you on the next one.